There is a market that is on the brink of collapse. US commercial real estate. Why you should be paying attention to it. Commercial real estate is headed for a real mess, and last but not least, distress in office market spreads to high-end buildings. What is the cause of it? The quick answer, 10 years of cheap credit. Take a look at this graph over here. You realize that US commercial real estate loans have surged $863 billion, which is about 62% since 2012. This next chart over here shows that US commercial property prices have more than doubled since their lows in 2009. If you didn't notice already, the chart is until 2020 only, and that's when everything was still going up. Today, it's a vastly different climate. It's arguable that this whole sector is on the brink of collapse because of two factors, and let me break it down for you right now. Hi guys, welcome back. Today we'll be discussing this whole topic in three key segments. The first is what are initial signs of this problem. The second is why this problem is getting more severe. And last but not least, what could eventually happen with regards to investing. Because if you are buying into US commercial real estate REITs, this is a risk that you need to pay attention to. So let's start with the first segment, initial signs of this problem. It can be traced back to 2020 where the pandemic actually started. You know, this whole pandemic has really shut down offices all over the world and has really challenged the way we think about work. Here in Singapore, where it's a city, the population is well connected, and the Asian work culture, I guess almost everyone is back to office in some form or another. But the same cannot be said of working in US.
A change in the way people work. Americans are working differently. Remote work is here to stay. Hybrid work is here to stay. And so there's a far less demand for office space. And that's putting a lot of pressure on REITs who have a large inventory of office space in markets like New York City.
You hear this comment? Remote work and hybrid work is here to stay. Now, REITs who have offices have been under pressure for a long while. Manulife US REIT and Keppel Pacific Oak REIT, both listed in Singapore, have dropped. But what about comparing them against the biggest US commercial REIT listed in US? This chart over here shows you that everybody in that sector is trending downwards and trending down fast. I will touch again on REITs towards the end of this video, so continue watching on. The main summary points of what we have heard, office markets have permanently changed in US at least. In financial district is vacant. There is a movement changing large offices into residential apartments. Now, how bad exactly is this vacancy problem? And before I show you a clip that I found to explain on that, help me smash the like button so we can reach a bigger audience. And if you appreciate this hard work to do this whole research for you, simply tap on that like button. And here it goes. In San Francisco, there is about 27.1 million square feet of empty office space. San Francisco is one of the hardest hit cities. And this over here is the new Salesforce Tower. It's a spanking new skyscraper with 1.4 million square feet in office space. It's an equivalent of 20 of such buildings looking for tenants. It differs from city to city, but I guess the general trend is roughly the same. This chart over here shows the overall occupancy index. You will realize that the grey line over there, which is class B and C offices, have actually started trending downwards from 4th quarter of 2021, correct? All things being equal, I guess a tenant would definitely prefer a class A office than class B or C office, whereby it's not so new, the facilities are old, and the location is definitely poorer. We can quickly guess that it's a renter's market out there, but by 4th quarter 2024, even US class A office space in central business districts have started to fall in lease. This is the first time since 2021, and according to Moody's Analytics, the owners of a number of high-end properties recently defaulted on their mortgages, highlighting the financial strain from rising interest rates and vacancies. This is an actual case itself. You will see over there that Brookfield Asset Management has recently defaulted on more than $750 million in debt regarding their 52-story tower in LA. With rental evaporating, commercial property values have started to slide in recent months. And for any buyer, they also face higher borrowing costs that impacts their ability to transact. Investors are keeping a close eye on property funds such as private equity firm Blackstone's REIT, BREIT, which has become a barometer of health for the commercial property market. It's one of the most high-profile examples that have been forced to limit withdrawals as rising interest rates have prompted investors to head for the exit. Now, speaking about this Blackstone REIT, problems actually started to surface a couple of months back. A latest report in March 2023 has suggested that investors have again wanted to pull out more than $3 billion for the 4th consecutive month. Just to explain it a bit deeper, Blackstone REIT is actually a non-listed REIT that primarily invests into stabilized income-generating commercial real estate across US. And because this fund is not daily traded, they actually have a cap of 5% redemption per quarter. What they own is real estate and buildings. You cannot simply sell it off with a click of a button. And you also want to avoid fire selling some of your assets. But the problem is investors are smelling blood and are trying to exit. Commercial real estate owners are now facing two major problems. The first, a drop in rent income simply because there's so much vacant space. It's so difficult to find tenants. The second is a drop in property value. When there's so many people thinking about selling, including a fund like Blackstone REIT, you will see that supply is way bigger than demand. But the problem does not stop there. Interest cost is the next challenge. To explain things, the interest cost that a commercial real estate investor faces is not the fat overnight rates that we hear in the news all the time. Neither are they on a long 30-year mortgage loan. More often than not, the debt is structured a few years up to 10 years. So let's use US 5-year Treasury to understand the pain that commercial real estate investors are facing right now. Interest costs have climbed up tremendously, correct? And as compared to the COVID period, property owners face an interest cost of at least 3% more. That's possibly why this article has stated that the party is over for commercial real estate and that the market faces a deluge of debt coming due at much higher rates. How about a different warning from the chief of JP Morgan Asset Management? Commercial real estate is the next sector that's under threat from rising borrowing costs after bank failures. From reports, there's about 2.6 trillion in commercial mortgages that are due to mature in 2023 all the way to 2027, according to Trap Inc. All this needs to be refinanced, and the majority of these loans are held by smaller banks. We've all seen the saga of Silicon Valley Bank, whereby their balance sheets have been badly damaged because they own US long-term treasuries that have dropped in value. But ultimately, Silicon Valley Bank, or SVB, is focused on lending monies to technology firms. But listen to this.
More than 80% of commercial real estate loans are held by banks with fewer than $250 billion in assets.
Indeed, majority of small local banks are in real estate lending, specifically commercial real estate. So these banks are actually getting wiped out on their balance sheets and also facing possible defaults on some of their loans that they've extended to commercial real estate. That explains why there's a lot of reluctance to lend monies out, especially when times are tighter right now. And this period coincides with a bad timing whereby a lot of refinancing needs to be done at a higher cost. Concerned about what's going on? Let's move on to the last part and guess what could eventually happen regarding REITs that have invested into US offices. Throughout this case study, I've been picturing a point whereby it's a buyer or renter's market out there and there's lousy bargaining power if you are the owner of office towers. You would need to spend to attract tenants in, and the risk, in my opinion, is hard to quantify. This over here is a presentation by Manulife US Trust. You will see that they've mentioned weaker leasing and higher incentives needed to satisfy tenants. Boxed up in the bottom left are tenant incentives which have continued to creep up for the last 2 years. This again is cost to you if you are invested in such a REIT. I'd like to quote from Richard M. Kimber also, who is a lead real estate portfolio manager. He's mentioned that he's consciously underweighted US offices since 2017 because he has realized that 30% goes back to capital expenditures or tenant inducement. So this problem is widespread across the sector, and we also need to understand when the REIT is giving 15 or 20% in dividend yield, it's almost impossible to do any yield accretive deals moving forward. The REIT can get stuck in a high yield trap whereby they can't actually grow moving forward already. Therefore, selling out to restructure is quite possibly a solution. Previously, there were rumors that Manulife US REIT could be acquired, but that again has been denied by its manager. The risk, however, still persists. If you buy today, you are not too sure will you get privatized sometime down the road at a much lower valuation. And that's why, in my opinion, don't go and be a hero. Go look for other sectors. There's so many different forms of real estate that have better bargaining power. If we see over here, you will realize that for the entire US property market, it has actually grown 5.53% for 2022. Offices are the biggest drag, declining by 3.37% for 2022, in particular for fourth quarter whereby they have experienced a big loss. If you compare that to hotel assets, which is what Escort REIT owns for example, there is still growth there. If you compare it to industrial properties, which I believe data centers should be categorized in, there is still some growth over there. These other sectors have more favorable dynamics, and although they are still exposed to macro problems such as recession and interest costs, I believe it's much better to go bargain hunting in these particular spaces. And as always, if you agree, smash the like button. And in a sequel to this video, I'll be touching specifically on spillover recession risks. So if you're curious, smash the subscribe and stay tuned for it. If you're looking for REIT investment ideas, I'd like to introduce you to two of my previous tutorials that relate to this also, and maybe they can help you understand a bit further before you put your monies down. I'll see you there too. Take care as always. Goodbye.